Welcome, everyone, to this episode of the Expansive CEO podcast. I'm your host, Hannah Chapman, and it is Thursday, October 16th at 1:37 p.m. Pacific time. So this is the next episode of Investment Friday, and my good friend Brad is back. Brad Haines, the Chief Investment Officer of Juncture Wealth Strategies, back from his vacation and here to talk about some stuff. How was your week, Brad?
It was really good. Thank you for asking. Yeah, it's been so far, it's been great. Um, Really not too much going on in the markets other than a lot of narrative change and a lot of different things that are rearing its head. So yeah, it's always changing and always evolving and keeping us sharp. So I like it.
Well, last week, before we recorded, was talking, just filling you in on what I talked about last week. And last week I recorded on Thursday, as we typically do. And Friday morning, news came out about Trump adding more tariffs on China, right? And so we had a big market move day on Friday. We were down last Friday, more than 300 points. It was a lot on the Dow Jones Industrial Average anyway. And then a big bump back up on Monday. It was up, I can't remember what it was up total, but it was like 1.4, 1.5% total on the Dow Jones anyway. So we had that big fluctuation last week, and we're still seeing some of that this week too, but we're kind of like back to highs. So tell us about, what the market's been doing. Um, Let's talk. We've talked a lot about tariffs, but let's talk a little bit about what's happening now with it.
Okay. So on Friday, President Trump came out and announced that he was looking at adding or putting back the tariffs to China to 100% because of he wanted to use that as negotiation. China has put some export controls on certain items to the U.S., primarily, or not primarily, but importantly, rare earth processed rare earth minerals, which are critical to electronics, which of course involves computers, computer technology, artificial intelligence, all of that uses rare earth minerals. And so they're very critical. And China is the world's largest producer of those rare earth minerals. Um, and honestly, I think until the US can find a secondary supplier of those rare earth minerals that are processed, um, China's going to have that stick to kind of hold over our head for a while. I think it's something that the Trump administration needs to be working on to make that more of a stable supply chain as opposed to um, politically motivated supply shortages that China could just out of its whim decide to cut us off. So that, with a higher tariff amount of 100%, right? All the investors go, well, all the goods coming from China are going to be that much more expensive, which is going to reduce household income. It's going to reduce business incomes. And as you reduce business incomes, what happens? Your equity prices fall. Okay. Uh, and in a very quick turnaround, he said, well, basically, we're open to negotiation. I want to do that, but we're open for negotiation. And so that this whole week there has been comments about China and the U.S. negotiations, and it's gotten interesting. In fact, last night Scott Bessent mentioned that the Chinese side trade negotiator is acting as a lone wolf, um, which was interesting that he characterized him that way. So we'll see what that if that helps or hinders the negotiation. But President Trump is supposed to or scheduled to meet with President Xi in the next few weeks, and so we'll see what that all turns out. But that is just one of many factors this week. The second thing, which is really, really important, is the shutdown. The
Mhm.
shutdown has basically ceased almost all official economic data that coming out about the U.S. economy, which is which is difficult for the equity markets to go higher unless we can rely on certain economic data, better economic data, or lower inflation that is going to increase earnings would help the equity markets continue to go higher. However, when you're at a peak or you're at a high, let's just say at its high from a lot of the broad market indices, um, you're priced a lot for perfection. Not
Hmm.
perfection, but you're priced for very good things to happen, to
Right.
continue to happen, to maintain that level of valuation. Um, and until we get data, we really can't see the impact of those good economic trends, or and so it's difficult to say whether things are continuing to benefit or hinder equity market returns. Um, you know, a couple of Fed governors have been speaking on both podcasts and on the news, and they've said that they believe 1 to 2 interest rate cuts this year. Right now, the market is set for 2 quarter point cuts in October and December. So
Mm,
we'll see how that all comes about. Um, but we have to remember inflation is over their target by quite a bit.
mm,
So do they err on the side of looking ahead and saying, you know what, shelter inflation is going to be coming down because shelter inflation is really, really tied to new tenant rent index. And the new
right.
tenant rent index has been negative, meaning rents are going down for new tenants rather than up. And so they're actually deflating. And
Right.
so, as we know, shelter inflation is the largest component of the CPI, of the PCE. And so if you see, new tenant rent index negative, you know your shelter inflation is probably coming down over the next 6 to 12 months. And so that's gonna draw down the overall inflation rate. Well, we don't know that until we get the official data. So that is one of the reasons that the equity market's going to be a little choppy here because we really don't have a lot of data to go by except for corporate earnings or economic data that's provided by private companies.
Right, which we talked about a little bit last week. And we can get some of that data, right, from you say Zillow or Redfin or these places that do a lot of big data aggregation on housing trends, or ADP on payrolls and new jobs and layoffs and different things like that. But it's interesting to see them figuring out that balance in real time, right? Like if we've talked about this before, the shelter inflation is a leading indicator, right? So it's like we're gonna start seeing this in the data, like you said, in the next 6 to 12 months. We know rents are going down, but it's not going to trickle into the rest of the data for a while. Um, yeah, which the Fed with their dual mandates here, right? Like we're starting to see some of those bigger layoffs from AI and from general economic uncertainty, um, inflation that could go down in the future. So I will be interested to see how the market reacts again. So if in October, is it probably the end of October, the 27th, 26th, something like that?
Yeah, hold on, let me get that data exactly for you.
Because they'll still meet, right?
Yeah, well, they're working for free right now or
Yeah.
limited. Yeah, so the 28th and 29th of October.
Okay. So as we always talk about, like what the decision is important, right? Like if they cut a quarter point or if they don't cut at all or if they cut more than that, what the number is important, but equally as important and sometimes more important is what is the narrative around the rate cut or hold or whatever it is. Right. So it could be like, oh, the market's expecting a rate cut. But if the outlook is more negative or sounds more negative than what the market expected to hear, we could see the market tank a little bit, right? It's like it's always such an interesting dance.
Yeah, I mean, right now for us, for the professional money managers and traders and analysts and economists who deal with the financial markets, we are looking at interest rates between July and December of next year.
Mm,
So this year, we've kind of have we kind of already think it's a lock. It's next year that's the big caveat. It's the big swing, because if the economy it surprised the upside in third quarter, right? Well, what if it surprises the upside in the fourth quarter, notwithstanding the lockdown? Well, that means we may not get as many interest rate cuts in 2026 as the market is currently expecting. Well, that's a negative event for equities, okay?
hmm.
Particularly certain equities. Or conversely, what if it says, hey, economic growth slowed more than expected? Well, we're probably getting more interest rate increases. And so that would actually push equities up because now you're lowering the cost of funds across the economy. So it's that dance that we're looking a little bit more long term than the next month or two. And that's really what's going to impact equities, bonds, your mutual funds, your ETFs, and the like.
So one thing that I'm reminded of from some of our listeners always is like, okay, so like, what do we do with that information, right? Like we've got the shutdown happening. We don't know when the government is going to come back on everyone's going to go back to work. For right now, we've got, you know, rate cuts potentially out there. We've got tariffs potentially out there and shifting and changing. But what do we do with that information? And one example that I think is important, I'm going to share, is that having a strategy, sticking with the strategy, and being patient, like as simple as that sounds, that's kind of like the biggest not secret, quote unquote secret to all of this. And the example I'll give is the, little bit of a flash crash we had on Friday. It was a little bit more of a dip than we've seen in the last couple of months. And we had clients who had cash and were waiting. Like, okay, we're just going to be patient, wait for a dip. And we waited longer than we thought we would for a dip, for some of that cash that was on the sidelines. Um, but when the opportunity was there. We were able to take it. Right. So it was here's the strategy. These are the parameters we're looking for. And when we hit those parameters, we'll execute. And literally that was the plan. And that's what happened. Um, so yeah, can you speak to that a little bit more too? I know it's like we
Yeah,
had a lot of clients that we did that with, but
yeah. I mean, what we've been doing. So I'm gonna address two things. One, we're towards the end of the year, right? We're in the fourth quarter. Fourth quarter is prepping for the end of the year. We're almost to the end of the tax year, which is important if your investments are in a taxable account. Um, we've been through equity markets have done pretty well this year. Um, some of the commodities like gold, silver, uranium, a couple of the others have done extraordinarily well this year. Um, bonds have done okay. Real estate, okay. Certain other parts of the equity markets, okay, they've done okay too. Well, how does your allocation look currently?
mm,
For example, if you start with a 50% in stock, 50% in bonds, well, that's probably 50 closer to 55, maybe, yeah, 55 to 60 to, you know, 45 to 40 on the bond side. You're probably overweighted in equities right now because we're all-time highs. Well, what are you going to do? Are you going to continue to do that? Or are you going to rebalance back to your targets to maintain your risk diversification? We've been rebalancing a lot. We've been taking profits in some of the equities we own. We've been taking profits in some of the commodities we own, gold and silver and uranium, not because we dislike them, just because they've run up so much this year. It's just time to take a little profit and buy and reallocate back to those assets that are perhaps maybe a little safer from a principal protection standpoint. Um, so we've been adding to some bonds, not because we necessarily love bonds at this level. It's because they are underweight in your allocation, and we want to maintain that consistency for your risk tolerance. Um, so that's one thing that I think clients, whether you have a financial advisor or whether you don't, that's something in the fourth quarter you should be looking at doing is, okay, am I overweight stock versus my target? Am I underweight bonds versus my target? What do I do here? If you have cash, okay, it's probably not a great time to add a tremendous amount to the equity, to the overall broad indices. I don't know if I would do that. But there are certainly pockets in the equity market you can certainly add to that will probably continue to do quite well. Um, if you have a longer term time horizon. So I would suggest doing that. And in the meantime, this is a great time to evaluate what does your realized capital gains look like? What does
Mm.
your dividend income look like? How are you looking to pay taxes on those income flows for 2025? Or do you have any securities in there that are trading at a loss that maybe you can sell, capture that tax loss, and lower your realized capital gain so you don't have to end up paying more taxes than is necessary? That's a really important aspect of managing money in a taxable account is harvesting those losses so that you don't overpay your capital gains taxes on a yearly basis. Sometimes that sounds very illogical to individual investors. Why would I sell an investment at a loss when I think it's going to go up? I understand that thought process, but you also have to understand that you can invest in something else the next minute. Like you sell the loss as long as you're not buying the exact same security or a security that is similarly identical, you'll be fine and you can capture that loss and still get some exposure to the equity market where you think it's going to go up. So I would encourage all clients to reallocate right now and then to harvest some losses as you have if you have any.
So you just said a lot of different terms, and we're going to unpack a few of those because I think those are really good um,
Perfect.
to talk about. And I did, either I talked about this last week or we've talked about this before, right? Like this, the active tax loss harvesting that we tend to do throughout the whole year for our clients. Because if you do wait until Q4 or November, December, you might have missed your chance, right? We might have gone through a period of volatility, especially in the summer or, sometime when it's typical September, right? Really typical for volatility to be happening. You might have missed that opportunity of like, oh, these things are actually low right now. We can sell them, buy something, like you said, similar enough, but different, similar in the way it's going to respond to the market coming back, but different enough that you're not going to get hit with a like, nope, you can't do that from the IRS. So a realized gain. Let's talk a little bit of that. A realized gain. So if you have a taxable investment account, this is not a retirement account. This is not an IRA. This is not your 401k. Those accounts are different. They have their own special tax treatment. They grow tax deferred. So we're just talking about your taxable investment accounts. If you have a realized gain, it means you sold something through the year. You had a stock or an ETF or a mutual fund and you sold part of it. Maybe you wanted to buy a car or you just wanted to sell something in the account because it was time to sell it. You're like, oh, we've held that long enough. We're going to sell it. It means you bought it at one price, it grew to another price, you sold it and you take that gain. So that gain is your realized gain. Your capital gain tax is going to be based on the amount of gain that you have at the end of the year. From January 1st to December 31st, we have this whole window of you can sell things, you can buy things, right? We can figure out how to balance your gain throughout the whole year. And that's the whole play here, or the whole strategy is that, like, yeah, if we sell something in January and you have $50,000 of realized gain, we can then plan throughout the year, like, oh, we can maybe harvest some losses throughout the year to chip away. Because if you sell another position for a $5,000 loss, that $5,000 loss is going to offset part of that $50,000 gain. This is not perfect. There are other stipulations in here. We're not going to go super deep into short term, long term, blah blah blah. Okay, very broad education. So you had that $50,000 gain. Then you had a $5,000 loss. Now you only have $45,000 of gain that you're going to pay capital gain taxes on. So again, it's this puzzle throughout the whole year. We're consistently looking at it, consistently strategizing how to lower your capital gains that you're going to pay. Because also, like you mentioned, in those taxable accounts, any dividends that you receive from dividend paying stocks or mutual funds, those are taxed. And you might receive interest as well. So if you receive any interest from any of your holdings, any of your bond holdings, or anything like that, that is also taxed in the year that you receive it. So we we manage all of that throughout the year. If you haven't been managing that to this point, that's another thing for you to think about next year, right? Like, okay, there might be some things you can do right now, maybe. Certainly look at it and see if you have any options, but it's really important to actually be paying attention throughout the year, because we've talked about this on the podcast too. We kind of go through natural cycles of, when the market tends to be higher, when it tends to be more volatile. It's not that it's exactly the same every year, but it's not predictable, but it has waves, right? Like we can plan-ish.
Yeah.
It's an art and a
We can
science.
estimate, right? We can estimate how volatile it can be throughout the year.
Yeah, exactly. So your realized gain is from what you have actually sold this year. If you look at your statement and you see a column that says unrealized gain, so you're looking at your investment account statement, you see this column says your unrealized gain. That's what the gain that exists that you haven't sold yet. So if you were to sell that holding, that is what you would have as a realized gain, and what you could potentially have to pay capital gain or regular income taxes on. Is there anything you wanted to add to that? Is there more nuance?
Yeah. Also, if you own old school mutual funds, so,
Hmm.
and these mutual funds have been around for a long time and they are in a taxable account, just be aware, and I'm sure you are, but I just want to keep in mind that when you're looking at your realized capital gains year to date, those haven't yet probably declared or paid their capital gains distribution for the year. That tends to happen in late November, early December. So, sometimes when you have those mutual funds that have been around for decades, they have positions that are highly elevated, very low cost basis, and sometimes they have to sell a portion of them to fund whatever they want to do. And so that those capital gains are coming out. It's just you probably don't know how much yet. So just keep in mind that there is some ambiguity until they declare their capital gains year to date or for 2025, that you may have a little extra gain in there than you were expecting, as happens from time to time throughout the years. Um, so because this has been such a good year and with some volatility, I would expect capital gains distributions to be a little bit higher this year than they were in the past couple.
Well, and let's talk about that just for a minute too, because I know we've talked about it in previous years, but it's one of those things that if you don't hear it, if you're not in the industry, you're not. It's complicated, but it's creates a what feels like a surprise tax bill for clients, and it's hard to swallow sometimes because when a mutual fund pays capital gains, what they do, I always go with the like $100 is the share price for your mutual fund. So we're just going to say it's at $100, and that's what it costs to buy one share of your mutual fund. When a mutual fund pays out their capital gain for the year, let's say this has been a bangerang year for them, and they're up a ton, and they have to distribute their profits. Well, let's say they're doing a 15% capital gain distribution, which is kind of it. That can be middling. Sometimes they're much higher than that. Sometimes they're lower. So we'll say 15%. So they're going to do a 15% capital gain distribution. You, as the mutual fund owner, can't do anything about that. There's nothing you can do to stop or mitigate that company doing that payout. But so we've got $100 per share for this mutual fund. They're going to do a 15% capital gain distribution. As soon as they do that capital gain distribution, you realize means you have a realized gain of 15% on your position, but the price of the mutual fund goes down to $85. So you have a capital gain of 15% on however much you have of that position. But then the price of the mutual fund, the actual value, when you open your statement and look at the value of that mutual fund, it's just gone down by 15% to account for the capital gain distribution. And so it can feel like a double whammy. Like I now have to pay this capital gain, but my investment, quote unquote, lost is what it looks like on your statement, lost 15%. And I just remember, clients coming in hot about that when they didn't understand it.
Yeah, I
Um,
mean, their cash balance is much higher, right? And
right.
sometimes you have to put those two together for them and say, look, this is the cash. You see that cash. Or if it's reinvested in new shares, then it's pretty much the same value. It's just you have more shares with a lower price per
And
share.
you have the capital gain distribution that you have to pay tax on.
Correct. You still have to pay tax on that, even though you don't have the cash because you have reinvested those funds.
Right. So it's like if you've ever had that happen, or if you've ever had, felt like this tax bill feels weird and bad and I don't like it, that it might be because of something like that. If you hold mutual funds in a taxable account, how can you get around that? There are a couple of ways. One, we are notified a little bit ahead of time of what funds are going to do. If they're going to have a big capital gain distribution, we'll know with enough time to sell. Like you could sell the whole position. If you have the mutual fund and you don't want to realize that gain or get the capital gain distribution that they're going to give, you could sell the whole thing. And then that avoids that capital gain. That's one of the ways, I mean, literally where I was before, we used mostly mutual funds. And that was one of the things that we looked at every year at the end of the year. But it's not always possible. Like sometimes it's like the gain is if you sell it, you're going to pay more in taxes anyway, and it's just you're in a tax spot no matter what, and it feels like well you have to pay taxes whether you want to or not. Um, the way that we kind of get around that now that I appreciate is that we mostly use ETFs and individual stocks and individual bonds. And I personally think that's so much cleaner and easier. We feel like we have a lot more control over the tax situation for any given client. But we have a lot of clients who bring over, right? Like when they move their assets to us, they have those legacy mutual fund positions. And so we do have to do this dance and we have to help them navigate through it until we can replace that position entirely if possible.
Yeah, that's exactly right. I mean, oftentimes we have to put together a capital gains budget, which effectively is, hey, how much capital gain do you want to have exposure to in any one tax year, right? If it's, 10% of the account value. So if you have a $100,000 account, your realized capital gains max would be $10,000, which means what? it means that's the gain that then the capital gains tax is applied to. So let's just say 15%, that's $1,500 would be your tax on that gain. Um, and sometimes you have to be very thoughtful about how you're taking your gains because taxes can add up to be quite an expense for your investment portfolio, as I'm sure we're all aware.
Right.
And so we want you to pay what's due, but we don't want you to overpay. We want you to pay just the right amount, if not less. So that's kind of what our goal is to help you navigate those situations.
So being October, I mean, it'll be October 17th when this is released. This is a good time to ask about that. If you're a client of Juncture and you're listening, you hopefully know by now that, again, we are looking at this proactively on your behalf already. But if you are, managing any of your own funds or you have another advisor, this is a good time to just make it ask the question, ask what their process is, what's been done, start doing some tax estimates for you over the next six-ish, 6 to 12 weeks, right? Is what we have for the rest of the year, which is crazy. And I don't want to think about it because it's too close. How did we get here already?
Yeah, I know it is a very, very difficult thing. I mean, it really is. I mean, it's wild how fast these things have gone. It
Yeah.
just really is.
Yeah. Yeah. It'll be Christmas before I haven't done any Christmas shopping. My husband is better about that than I am. I am like gifts are really not my love language. I have a hard time with them, but he is like that is one of his love languages is gifts. And so
Oh,
he's also good at buying them
yeah,
ahead of
yeah.
time and hiding them.
That's
So,
great. And now you have a new house where he has lots of different places you've never figured out.
right? I don't know where anything is. So if you're in the same boat here, yeah, like it's middle of October and Christmas is coming. So
Yes, yes, it's coming fast.
is there anything else that you wanted to share? This is a perfect time to go over. Um,
No, I think
yeah,
keep the course, stick with your long-term financial plans. Um, if possible, if you're feeling a little nervous, with the markets being at their all-time highs, take a little risk off the table. There's nothing wrong with that by reallocating and rebalancing your portfolio thoughtfully. Um, and if you need a financial advisor or a money manager to take a look at your portfolio and suggest changes, Hannah and I are here. We would love to talk to you and to look at your portfolio and see what we can do and how we can better it, and help you minimize your taxes related to your investment portfolio.
absolutely. And if you have any questions, coming up that you're wondering about, we are always open. I get good questions from clients, and am also happy to take questions from anyone else that hears this. You can send me a DM, you can send me an email, you can get Brad at all of the contact information below. So hope you are weathering all of the storms, literal storms too. Arizona has had some insane storms. Weathering the storms of weather or life or whatever is happening for you well, and we will see you next week. Thanks, Brad.
Thank you.
That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at Hannah, HANNAH, at expansiveceo.com and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough, you are enough, and your birthright in this lifetime is to be expansive.